Welcome back to another episode of the Isn't That Rich podcast. We are back again with our CFO, Matt Busanero, who has more updates on the 2024 tax laws, but this time we're talking all about businesses and what they need to know for the new year. So welcome back on, Matt.
Great to be with you all.
Yeah.
So the business section may be shorter than a little bit of the other ones, but it's obviously a very important topic. We have a lot of small business owners out there, and we want to make sure that they are armed with all the information that they need to do their taxes appropriately. So before I get into it, disclaimer. I am not a tax authority. The IRS and the state taxing bodies are the ultimate tax authority, so any information that's provided here may not be relied upon. However, if there is anything there you would like to pursue, please consult your tax advisor, as they are best able to advise you based on your individual tax situations.
Amazing.
End disclaimer.
Incredible.
I love the disclaimers.
Incredible.
I don't know. It reminds me that we need to do some disclaimers more often.
Probably, because we're not financial advisors.
That's right. But I think that's in our notes too, in our episode. So go ahead, Matt. We'll get you started.
All right. So for businesses, probably the main thing I want to talk about, and of course we have questions. We can go in any sort of directions we want to go here. But the main thing I want to talk about, I think is most pertinent, is depreciation. And I say that for a couple reasons. One is that depreciation is probably the easiest way for a business to legitimately manage their taxable income. There are so many options that are available to accelerate or slow down the depreciation deduction depending on the other factors of your business. That it's a pertinent topic to talk about. So we'll start with that first. We have had for many years a concept called bonus depreciation. It's been 50%. It's been 100%. This year it is 80%. It's going to go down to 60%. For 2023 filing season that you're getting ready to prepare now, your 2023 taxes, it's 80%. In 2024, it drops down to 60% and will continue to decrease from there. Basically, what bonus depreciation is for any sort of long-lived asset, which think real estate, buildings, equipment, those sorts of things that are going to last up for a good number of years, you are able to depreciate those items. The IRS has a chart that tells you for certain types of items, here's how long you're allowed to depreciate it. And what depreciation is let's say I buy a $10,000 piece of equipment, and the IRS says that piece of equipment is to be depreciated over 5 years. I'm going to take that cost of that equipment and write it off over a 5-year period. So I don't get necessarily a $10,000 deduction the day I buy it. I'm going to depreciate it over 5 years, except for bonus depreciation. That allows anything that has a class life of 20 years or less you can write off, because this in 2023 is 80%. You can take 80% of the cost of it immediately and depreciate the remainder over, for in our example, the 5 years. So it's a big benefit instead of getting maybe $1,000 year one and whatever year two, and it's not straight line depreciations. It's an accelerated Maker's modified accelerated cost recovery system, so it's not straight line. But it's a big benefit to get as much as you can up front. There's also a concept called Section 179, which allows you to write off the cost of all equipment immediately, and certain types of building property. We'll get into that a little bit in a second. Which building property qualifies for Section 179? You can actually write 100% of it off up front. The caveat being, taking that deduction can't cause you to have a loss on your business. So it's there, but it's not necessarily available for everybody unless they meet certain criteria. It also has to be for an active trader business. So, if you've got rental property, you're not going to be able to take Section 179. It's only for active trader businesses. So think retail establishments, banks, service industries, those sorts of things would be eligible to take 179 if all the other factors fall into place. The beautiful thing about bonus depreciation, it's available for any type of business, whether it's rental or active, regardless of as long as it falls in the right category, and it can cause you to have a loss.
Okay.
So a tax loss. So it's kind of a nice benefit that maybe if you don't qualify for 179, you can take the bonus depreciation. So that's kind of the nuts and bolts of bonus depreciation. Let's pivot a little bit to Section 179 because a lot of small businesses are going to be eligible to take Section 179, which again is the immediate depreciation of personal property and certain business assets. So that threshold is pretty high this year. The maximum 179 deduction this year is $1.2 million. So let's say you've got, before considering depreciation, a $2 million net income, you can reduce that by $1.2 million if you have at least that much of new equipment purchases during the year.
Okay, so you're a business and you have $2 million in income, and say you purchase some new real estate, and does that count? I mean, that's kind of what I'm thinking and trying to understand.
Sure.
So
it depends. So
yeah, it depends.
So if you buy something new, like land, you can never depreciate land, right?
It stays the same.
It stays the same.
Okay.
And if you buy a building, you can't do the exterior portion of the building, but there is a concept called qualified improvement property that is eligible for Section 179. That's going to be any improvement made to non-residential real property, and it excludes basically the exterior building of the building, enlargement of the building, elevators or escalators, or changes the internal structural framework. So it's improvements to the interior of the building basically would be potentially eligible for Section 179.
Okay. So if I put a new roof on my building? No.
You can depreciate it.
You can depreciate it, but that's not it. Okay.
Right.
Got it.
So, but thank you for the question as far as the real estate goes. Something that I would like to talk about that's very pertinent to somebody who is buying a commercial building or is constructing a commercial building would be a cost segregation study. Those are very important and highly recommended for anybody who's in that situation. And what that does, generally speaking, you buy a building, put it in service that's used for a business, it's going to be depreciated over 39 years. But if you have a cost segregation study, what that basically involves is getting an engineer involved. You'll provide them a copy of the blueprints of the building, maybe invoices if you constructed it, involved for the construction of the building. They'll come on site, take pictures, that sort of thing. And what they can do is carve out certain elements of the building, and they will be eligible for quicker depreciation. You may even be able to take bonus depreciation on some of those items because some of them will qualify for maybe a 5-year life or a 7-year life, which is less than the 20-year life that it has to be to get bonus depreciation. So those are very important. So for instance, we built a new branch in Harron this year, and so that's one of the things we did is we contracted with a firm that does cost segregation studies and had them do an evaluation of it for us. And so there's going to be some significant benefits to that for us. And so, there's not. So I would recommend if you're in that situation, talk to your tax advisor because they probably have a firm that they're used to working with that does these cost segregation studies. There's not necessarily, I don't know of anybody locally here that does them. The outfit we used, the gentleman we worked with is out of Louisville, but there's not a ton locally, but your tax advisor will probably have someone that they work with that does these sorts of things, and it would be very advisable to do that.
That's great to know. So we can even include the people that we've used. I know I've done a cost segregation for my medical building as well that I own, and we can include some contact information. Why not in the show notes? Because people around here might want to use that. So, not that we recommend or have anything to say good or bad, but it's just a place to start.
Yeah, absolutely, absolutely. So another big item that you're going to see a lot is solar panels. So that is an asset that a business can buy, and not only do they get credits for those, but they can also depreciate those as well. So kind of the nuts and bolts on how that works for businesses is you'll get a credit for the cost of those. Normally, when you get a credit for some sort of expense, you reduce the cost of that by the amount of the credit. So thinking back, earned employee retention credit, we talked about that in a previous podcast and the fraud that goes along with that. But there was also some legitimate businesses that qualified for employee retention credit. So when they received that employee retention credit, they reduced the amount of their wage deduction that they would get by the amount of the credit they got. So you can't double dip, you can't get money and deduct the expense that money paid for. Mm-hmm. One of the beautiful things about the solar panels is the amount of credit you get for those. You only have to reduce the amount that you're able to depreciate by half of the credit. So instead of reducing it by the whole credit like you typically would do, you get to reduce it by half the amount of the credit. So that's kind of a nice benefit that you get on top of the energy savings from that and the credit you receive. You get to depreciate half of the credit that you realize along with the remaining cost of those solar panels as well.
So question for you. I go and I install solar panels in my business, and do I only get that credit that year that I install them?
Yes.
Or I'm sorry, I guess I don't know how it works. Is it annually that I get this kind of a thing, or what is? I mean, I guess it's structurally that you're putting it in that year, and that's when you're paying for it. So
correct. So the credit will be realized
that year that you pay taxes on it.
The depreciation will be, depending on how you do it, could be spread over the life of that asset, or if you take the bonus depreciation, you may get 80% of it that year, and then the 20% of it over the remaining life of that asset.
Okay, that makes sense.
So, that's really the big thing that I have for businesses is depreciation. The other things that I would say is, make sure you are compliant with your 1099 filing requirements, because there are penalties that are assessed if you fail to provide vendors with that should be receiving 1099s with 1099s. If a business does work for you more than $600, you're required to provide them with the 1099. The exception being if they're incorporated, you do not have to provide them with a 1099. So you're just talking about individuals and partnerships and LLCs that you would have to provide a 1099 to. So other types of businesses. So that's kind of a hurdle. And that's why it's important. You mentioned in the previous podcast a W-9. And I would advise anybody to do this. If you have a new vendor that you're working with, you've never worked with before you pay them what you owe them, have them complete a W-9, because that will provide you with their name, their tax ID number, whether it's a social if they're an individual, or an EIN if they're a business, and it will tell you what type of business they are, how they're organized. And so that will be your kind of get out of jail free card if you don't send somebody, that sounds horrible. If you don't send somebody 1099, we could say, well, hey, they're a corporation, so I wasn't required to send them a 1099. If you pay them and they're only going to do business with you once, if you pay them and they haven't had that completed before you hand them the check, it's going to be infinitely harder to get that, because people have a way of disappearing on you.
Yeah, it's easier to hold that little carrot, right?
Like, you want the check? Here you go. You got to fill this out.
Yeah.
So that's just a best practice. That's not tax law. That's just best practice.
That's a good tip, though. I mean, I didn't even think, and that's anybody you're paying to work for you over $600. So if they're coming,
that's not an employee.
Oh, that's not an employee. So this is any kind of contracted position.
Yep. Yeah. Really, if anybody Well, yeah, you can use $600. If you don't think you're going to pay them $600 over the course of the year, then you wouldn't necessarily have to get a W-9. But I just think it's best practice because maybe you don't do over $600 worth of business with them this year, but maybe next year you're going to use them again, and you might go over $600. You've already got it on file.
You got the information.
And so unless something changes with them, you've got that. Some businesses will make it a course of habit to get a W-9 every year. To me, that's not necessary unless something has changed with their organization. I guess maybe the argument's like, how do you know if something's changed or not? So maybe it is a good idea. But regardless, don't pay them until you got the W-9.
Where do you get a W-9 at, Matt?
You can Google it.
You can print a W-9 off.
Yeah.
Google Form W-9, and it will give you a link to the IRS's website.
And you print it off.
And print it off.
It's so easy. You just go in there and you put in your information and print. That's it. It's so easy.
You can, if they're a business that you transact with through email, you can email them the W-9. It's a fillable PDF. They can type it in. If they're not super tech savvy, you can print one up and have them fill it out with pen and ink.
Yeah.
Super easy.
So easy.
You don't have to wait. You don't have to wait for the government to mail you.
No,
because they won't.
On a horse and
They won't.
carriage.
No.
A W-9.
Well, as a business, if you have a business, you're responsible. We've learned that, right? It's
Exactly.
You can't
Right.
claim that you didn't know about it. You're obligated to know those things.
And that is for every business. It's on literally every schedule, whether you file a corporate tax return, partnership tax return, or a Schedule E or a Schedule C on your individual tax return. They're going to ask, did you provide 1099s to everybody that was required to receive one? So you're kind of putting yourself on the line that yes, I did it, or no, I didn't do it. You can't leave the question blank. You got to answer it.
Got to answer it, and that's when they're like, "Here, see, you said you did."
Leave it blank.
Yeah. Well, good to know. I have a couple more questions about deductions.
Absolutely.
So, say I am a coffee shop and I'm buying equipment that only has a lifespan of. It's a huge investment, but it's like, upwards of $5,000, but it only lasts 5 years. It's less than that. How are your deductions
Sure.
scheduled? How does that work?
Yeah. So that would be a perfect example of something that could be eligible for Section 179 or bonus depreciation, or you may want to just write it off over 5 years. That's why I say it's really easy to manipulate your earnings if your business using depreciation. If the coffee shop had a fabulous year, you're going to want to take that now and minimize your tax liability. So you would report that. You would take the Section 179 deduction, which is reported on Form 4562, and that's where you would get that deduction. Or let's say, the coffee shop didn't necessarily, say the coffee shop before depreciation has a $4,000 profit. Well, you're not going to be able to take 179 for all of that. But you could take the bonus depreciation and, zero out your profit there. And that would also get reported on Form 4562. It just shows up on a different line on there. Or let's say, coffee shop didn't have a great year this year, but because maybe you opened in November, right? And so, but you expect next year is going to be really, really good. Then maybe you wanted to depreciate it over the 5 years and have some deductions available for those future years where you expect the income to be better than it is right now. So as I say, there's so much flexibility, and it's completely legal flexibility that's allowed by the tax law. And so you don't have to play games. You can just
Figure it out.
And whatever. Really, you can look at it year by year. Sounds like. Or do you say?
Well, once the year you placed in services is kind of how you determine the fate of that asset. But
so you got to know that you can't say next year I want to push it down, kick it down the road.
But next year you're going to probably inevitably buy something different, and so the way you treat something you purchased the next year can be completely different than the way you treated things you purchased this year.
Interesting. So. You can't just write everything off.
Write it off.
Yeah.
Dan Levy.
This is good. Anything else you want to tell our listeners about this new year for businesses?
Well, those are pretty well the highlights. We talked earlier today, and I apologize, I don't remember if it was in between sessions or if it was at the end of the previous podcast that we did about the timing of deductions, and I think that is pertinent to businesses in particular, because they're the ones who are probably more concerned about buying something and deducting it. And so a lot of times folks are thinking, well, I've got to spend money to get my tax liability down, and that's probably true. But I think in their mind, they think if I buy $100,000 piece of equipment or whatever, prepay $100,000 of, in the farm context, maybe fertilizer that I'm actually not going to use until next year, but I'm going to prepay it now. The thought in my mind is, okay, so you're, for example, in the 35% tax bracket, I'm going to pay this $100,000 expense. It's only going to save me $35,000 in taxes. I mean, only. But, if you keep that $100,000, you're going to pay $35,000 in taxes and have $65,000 in your pocket. So the question is it worth paying $100,000 to save $35,000 or not?
Right.
And so I think what you really need to do is evaluate need. So if I need to do this, then I should spend that money. And then it comes down to, once you determine, yes, I need this and I need to spend this money, then the question is, when do I want to do it? Is it something I need right now? Or is it something I'm going to need sometime in the next 12 months,
9 months,
whatever. If I'm having a really, really good year this year and I don't expect next year to be as good, and this is something I need, I should pay for it now, because the deduction will be more beneficial now than it will be next year. And conversely, if next year is going to be really, really strong based on what you're forecasting, and this year is not as strong, then defer that, push it off, and save it for a year when you really need it.
We keep using this $100,000 example and the $30,000 taxes. Okay, I get what you're saying, but what if you buy something that's $30,000? And I'm not saying it's that easy, like apples for apples, like you spend some, but maybe it is. Do you know what I mean?
Right.
You're like, well, don't spend $100,000 to save $30,000 on your taxes, but
you're just trying to make me do math, aren't you?
I think it's
I can do it.
I really am trying to make it easy. But what if I just spend $30,000 on something for my business, and then that's the full tax write-off, right?
Well,
right?
Only if it's a credit. If it's something that qualifies for a credit. So if it's a deduction,
Okay.
you're going to take whatever amount you spend and multiply it by your tax rate, and that's the actual amount of taxes that it saves you. So
Okay.
I even joke about, let's say taxes were 90%. Well, that's horrible. But if I make $1 million and I'm paying 90% in taxes, I'm still 10 cents on the dollar richer than I was had I never made that $1 million. So,
Yeah.
It just, unless you need something, to me, it's not worth buying something just to buy something to save taxes.
It's like buying something on sale just because it's on sale, right? Like, do you need it? Is the savings? You still are spending that money.
I know, but I know we know we're all saying, but it's like, if you're looking at it like this, well, am I going to pay $30,000 to the government to just pay my taxes, or can I pay the $30,000 for a piece of equipment? I know,
but
and then I bought it for something.
If you
You're spending the money either way. So do you want to spend it towards your taxes or for something?
Well, but okay. So for your example though, if you're going to owe the government $30,000, you're going to have to spend $100,000
to be
offset the $30,000. Otherwise,
that's what I'm trying to get clear.
if
It's not. That's what I'm saying. It's not just apples for apples.
It's not just apples for apples. Exactly. So if you've got a $30,000 tax liability and you buy something that's $30,000, that's going to save you $9,000 in taxes.
Yeah, way less.
So you're paying $51,000 instead of just paying $30,000.
Right. So
Golden.
it's not
So
apple for apple.
That's what I'm saying. I think people
around
have that misunderstanding about that.
Right. Yeah, exactly. So thank you for proving my point, probably in the more common sense way than I was trying to say it. So you're looking at what's the total cost of it. So if I'm paying buying a $30,000 piece of equipment, thinking it's going to reduce my $30,000 tax liability, but really what it is it's costing me $51,000 because I got a $30,000 piece of equipment and I still owe now $21,000 instead of 30,000.
30,000.
Yeah.
So thank you.
Yeah.
You're welcome.
Way to go, Ashley. Appreciate that.
I'm not trying to fight with you guys. I mean, I just really want people to understand this because I think people do talk like that.
Yeah. Or try to avoid taxes in other ways. Yeah.
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 When really it's probably just costing you more. Just pay the tax.
Just pay the tax. In the long run, it'll.
Yeah.
Exactly.
Yeah. All right. Well, thank you so much, Matt. Anything else you want to say before we close out this episode?
I just appreciate having the opportunity to talk to you ladies and to our listeners out there, and I hope you all have a very good tax season and no unexpected surprises. And just one piece of advice that I think I mentioned earlier, maybe in another one of our podcasts. If you're thinking about doing something, and I have said a lot today, talk to your tax advisor. It's and that's very key. I can't tell you how many times, especially when I was practicing, where someone would come and say, "Hey, I did this," and you just want to cringe when they say, "I did this," because like, man, if you had talked to me before, we could have structured this in a way that would be more beneficial to you. You may end up getting what you got, but not have the pain of the additional tax cost, because sometimes structuring something is so important. So when you're thinking about doing anything big for your business or personally for that matter, that could have a tax impact, talk to your tax advisor before you do it and let them know what you're thinking and let them work with you to make sure you do it in the right way, because it can be a big savings to do it the right way.
Yeah. So. That's so good. I even, just to add on that, I think about people who are looking up how to structurally set up their business, whether you do an LLC, whether you're a sole proprietor. Like, before you go and do that, I think it's good to talk to a tax advisor too.
Yeah, absolutely.
Because that changes things, like he even said about the incorporation.
Yeah.
Yeah, exactly. Both your accountant and your attorney. The attorney will be able to advise as far as the liability protection, and of course several of these different types of businesses are set up the way they're set up for a liability purpose, but there are tax implications as well. For example, did you know LLCs get to choose how they're taxed? So if you have a single member, one owner LLC, that is always going to be on your individual tax return, so they don't get a choice. But if you have, and for LLCs, the owners are called members. That's the terminology that's used in an LLC context. But if you have a multi-member LLC, they get to choose how they're taxed. So by default, a multi-member LLC is taxed like a partnership. However, they can elect to be taxed as a C corporation, which is a type of entity that pays its own income taxes rather than the owners paying income tax on it. And so the downside of that can be there for a C corporation is the business pays taxes, and then when they make a dividend to the owners get to pay tax on that money again. So you hear about double taxation with C corporations. That's the downside of it. They can also elect to be taxed as S corporations, which, like a partnership, is a type of entity that passes that income on to the shareholders, and the shareholders pay tax on it. The benefit, of course, is whenever the S corporation makes a dividend or distribution to the owners, they don't pay tax on that because they've already paid tax on it. So it's previously taxed. Something I did fail to mention, and this is a big oversight, I apologize, something that's new for pass-through entities, which are your S corporations and your partnerships, is there's a new federal deduction called the pass-through entity deduction. This is actually beautiful. So
wow.
If you are a owner of a pass-through entity, partnership, LLC, or S corporation, there's a pass-through entity deduction. So the business pays the owner's share of the state income tax. So Illinois and each state elects whether or not to participate in this. Illinois has participated in this. So the corporation, if you elect to do this, will pay the tax on behalf of the owners, partnership or corporation, I should say. The business gets a tax deduction on their federal income tax return for the tax they paid on behalf of the owners, which is pretty cool.
Yeah.
And the owners then will, when that flows through to them, basically get a deduction for the tax that the business paid for them. So, we talked earlier about how individuals on our itemized deductions are limited to a $10,000 state and local tax deduction. A business is most likely going to have a bigger tax liability than that. So through this deduction, they basically get to deduct their full share of the business taxes for this particular business.
Wow.
And on their Illinois tax return, they get a credit for the taxes that the business paid on their behalf, which could cause them to get a refund in Illinois.
How did you forget all that?
It's like, I know, it's huge, right?
Oh my gosh.
It's
So
like,
good.
This is like the second or third year for it, so it's not brand new, but it is like
That's a good.
pretty huge and awesome, and I'm pretty excited about it.
It's beautiful.
Everybody wins.
beautiful.
It's a
Never heard a
win-win-win.
tax advisor say it's beautiful.
It is a beautiful thing.
That's great. That
Very-
sounded really good.
very
Like on a
rarely
lot of
do we
levels.
get-
I don't even really understand it, but that's awesome.
Very rarely do we get win or win-win, but we get like win-win-win
Win-
here. So
Wow.
it's great.
You know what that means? Someone's losing somewhere else, right?
I don't know what this
Everybody
one.
wins.
I don't know.
The states like it because sometimes they may get stiffed if an owner doesn't file their tax return or decides not to pay, or people can be knuckleheads, right? We know
Right.
we
Yeah.
know that, right? We see that every day. So the state likes it because the business is paying the tax on behalf of the
owners.
so they get their money whether or not the owner files or pays taxes or not. They've already got their money, so
Right.
literally win-win-win. Everybody wins. Business wins, owners win, state wins.
Not often it
Everybody
happens,
go-
but they're winning in
No.
this one.
Everybody goes home happy.
That's so great.
That's awesome. Well, thank you, Matt.
Yeah, thank you so much for
So
being on. This has
good.
been great.
It's been my pleasure.
Yeah, it's been a fun morning. So
Been a fun tax series.
yeah,
That's right.
for sure.
Do it next year.
Do one next year.
Absolutely. Thanks again for tuning in to another episode, and we will see you next time.
So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.